We're looking at a very timely analysis report on the huge 12.24% surge in POET technology stock. It links a high-volume breakout to Google's AI spending, all under the title Maximum Momentum: Why POET Stock is Flying Today. It's high energy for sure. So the job is to make the analysis just as solid as that title. Let's dive right in.
Yeah, that title really does capture the feel of a big market move. And the report does a great job of immediately identifying the puzzle here. You have a huge volume spike, 14 million shares, and absolutely no press release from the company. So, pinpointing that Google AI spending news as the real catalyst, that's just excellent market detective work.
Right.
But to really serve the kind of sophisticated reader this is aimed at, especially for a high beta stock like POET, we have to tackle the competitive side of things right away.
Okay, so our first point of critique is about bolstering that specific connection, moving beyond the general sector news to POET's actual competitive advantage.
Exactly. While identifying the Google news is insightful, the analysis really needs to sharpen the direct, proprietary link between the sector-wide demand and POET's unique positioning.
Looking at the report now, the logic is basically more data centers equals massive demand for optical interconnects, which that's a sound premise. But it does leave you asking, why POET?
It's a weakness. That argument is fine for, a general market overview, but for a deep dive analysis, relying on a sympathy play just isn't enough. It completely overlooks the competitive landscape. I mean, it almost implies that POET is the only solution for this 800G or 1.6T speed bottleneck.
And it's not.
Of course not. So a truly robust analysis has to demonstrate why this specific institutional volume suggests funds are positioning in POET for its 2026 commercialization and not, say, a competitor who would also benefit.
Okay, I see. So the weakness is not giving the reader that tangible proof that POET is the inevitable winner. But here's the question. The author clearly wants this high-energy, maximum momentum tone. If we start layering in dense technical specs, don't we risk losing that energy?
That's a critical point. And the suggestion isn't to turn this into some dry engineering white paper. Not at all. It's about embedding selective, really powerful facts that justify the momentum. The report needs to strengthen the evidence that positions POET as the superior supplier for these new AI data centers.
So moving beyond they make the parts to they make the best parts for this specific job.
Exactly. The specific killer app advantage.
Okay, so let's get concrete. What are some examples of things that could be added right now to bolster that claim without slowing it down?
Well, the first and maybe easiest path is to focus on efficiency. Right after the connection section, you could add a quick point about a proprietary aspect of POET's optical engine, something that speaks directly to big tech's biggest headache:
Power consumption.
power consumption. Is there advantage in, say, superior power per gigabit, or maybe a much smaller physical package? That's the kind of thing that matters at massive scale.
And why is that metric, power per gigabit, so important to an institutional investor reading this right now?
Because AI models are absolute energy hogs. When Google announces a multi-billion-dollar spend, they are budgeting for decades of operational cost. So if POET's platform offers, say, even 20% better power efficiency,
At that scale, that's billions of dollars in savings.
billions, it's a quantifiable mode. That's the sophisticated reason an institution would buy the stock today for revenue that's coming in 2026. That detail justifies the momentum.
Okay, that definitely reframes the technical detail as a financial indicator. What about the other proof points in the report, like that production order?
Yeah, we can elevate that. The October $5 million production order? Right now, it's just used as proof of concept. We need to leverage it as real, tangible evidence of viability. And then, this is the key, link that viability to the specific kind of tech these new AI data centers need.
So if that $5 million order confirms something specific, like the scalability of their light source, the report should spell that out.
Precisely. They bought this because it solves an AI scale problem better than traditional methods. That's the proprietary link.
And what about the competition? How should the report handle that?
You have to name check them, even implicitly. You can maintain the report's bold style and just state why POET is the superior picks and shovel solution. For example, if competitors need costly active alignment during manufacturing, and POET's platform eliminates that.
You highlight that cost-saving manufacturing advantage.
You have to. Without that level of specificity, it just feels like another sector play, not a unique winner that deserves a massive high-volume breakout.
That absolutely sharpens the thesis. Okay, let's shift gears to the overall credibility. The report is obviously very bullish, which is fine, but I think there's a huge opportunity in how it handles risk.
I agree 100%. To elevate this from a high-energy, bullish narrative to a truly comprehensive investment document, it has to integrate a balanced discussion of the potential downsides.
And the weakness right now is that it's just overwhelmingly optimistic. You have phrases like, the chart is screaming, the path of least resistance is up, and dips are for buying.
And that kind of enthusiasm is great for getting people excited, you know? But it can accidentally reduce its credibility with more sophisticated readers. It doesn't address the inherent risks of a commercialization stage stock. It notes the heavy institutional flow, for example, but it never asks what could make this thesis wrong.
But wait, if the whole point is maximum momentum, isn't adding a whole risk section going to kill that vibe? I mean, isn't the point to rally support, not scale the people off?
That's a really common misconception. The suggestion isn't to add a scary warning label. It's to introduce a small, defined section on risk, but frame it as a check on the strength of the bullish signals. By acknowledging risk, you're showing you've considered the counterarguments, and that actually reinforces the conviction in your thesis. It strengthens the whole analysis.
So it's actually a strategic move to build more confidence. Okay, how do we do that without it becoming, a section of doom and gloom?
First, you can use the technical analysis. The report does a great job establishing $7 as the new critical support floor. Right after that, you can pose an analytical question. Something like, is there a risk that a failure to hold above $7 could mean the institutional flow was just short-term positioning, not long-term accumulation?
Ah, so it gives the reader an immediate signal. If this level breaks, the thesis needs a second look. That's very actionable.
Exactly. Second, when you talk about the 2026 commercialization timeline, you briefly outline the main risks to that timeline. Maybe you mention the potential failure of follow-up orders to materialize or some unexpected supply chain issue. You just need one sentence, but its presence shows you've done the due diligence.
And what about the immediate price targets?
Acknowledge the high probability of hitting that 52-week high, around 941. But you also expertly add the potential for some consolidation, maybe around the psychological $8 target that analysts have set. It prepares the reader for volatility. It shows the writer isn't just a cheerleader, they're a sophisticated market observer. And that makes the whole thing far more credible.
That makes a lot of sense. And it brings us to our third major point, which is the structure, the way the facts are laid out versus the speculation. I think it could be stronger.
Yes, the flow could definitely be optimized. It's about clearly separating the objective technical evidence from the more subjective analysis of the catalyst. The weakness being that the current structure puts the hard data, the price action, the volume, before the speculative part, the Google connection. So it reads, what happened, then why? And to a professional reader, that can feel backward. When the why, the speculation, comes right after the what, the data, it can feel like the conclusion is driving the analysis.
Like you started with the Google theory and then went looking for a chart that fit.
Exactly. Instead of the market sending a clear signal first, which then prompts the detective work to find out why.
So the suggestion is to reorder it. Establish all the undeniable facts first, the technicals, the analyst ratings, before you introduce the core theory about Google. How does that change things for the reader?
Structure is narrative control. When you present undeniable facts first, the massive volume, the price-flipping support, the reader is already thinking, wow, something big is happening here. The momentum is real. Then, when you introduce the catalyst, they see it as a compelling interpretation of the market signal they've already accepted, not just the reason for the report. It gives the technicals so much more weight.
It shifts the entire frame from breaking news to evidence-based thesis. Okay, let's walk through the exact steps for restructuring this.
First, I'd combine the what, which is the breakout confirmation, and the technical analysis section into one big section. Call it something like market confirmation and objective technical facts. This is where you group all the hard numbers, the 761 close, the 14.1 million shares, the $7 support flip, the path to the 52-week high. These are just the facts of the tape.
Okay, so you're front-loading all the market certainty. What's next?
Second, take the analyst upgrade section. It's kind of floating in the outlook right now, and move it to immediately follow those technical facts. You establish the Wall Street consensus, the strong buy ratings, the rising price targets, so now you have the market action and the analyst sentiment backing it up. It's a 1-2 punch of objective conviction.
So now the reader has the hard technicals and Wall Street's blessing. The stage is perfectly set for the final piece of the puzzle.
Precisely. And third, you reframe the core catalyst section, the Google Alphabet ripple effect, to use all that data you just presented as the starting point. Instead of just stating the news, you frame it analytically. Ask a question. Start with something like, given this unprecedented institutional flow and rising price targets, what is the hidden catalyst that explains this move?
Yes, so the Google theory becomes the answer to a question the data has already posed.
Yes, it frames the narrative as an interpretation driven by overwhelming data, and it makes the maximum momentum theme feel completely justified and earned.
That really does transform it from a market update into a fully reasoned investment thesis. Okay, I think we've covered 3 really big areas for improvement here.
And I want to be clear, this is a very strong foundation. The core insight is sharp. These adjustments are all about presentation and robustness, just ensuring it can stand up to the highest level of scrutiny.